Hello and welcome to this masterclass on client money and asset protection. I'm John Beck, the Banker's Trading Technology Editor, and I'm joined today by Philippe Chambedal, CEO of SmartStream. So Philippe, let's get the basics out of the way first. And when we talk about client money and asset protection, well, what do you actually mean by that and why is it important?
Well, it's very important both for the banks and the clients. The concept is to have a proper segregation of the client money as specified by the FSA and the other regulators, so that overnight the client knows that there's protection on their funds and that there's no commingling of their funds with other clients or with the bank's own funds.
And why is this a kind of topical issue right now?
Well, obviously, the issues with MF Global have highlighted the fact that although some of the clients thought that their funds were protected, in effect they were not, because the money was commingled within the accounts of the firm.
Sure. And have there been any other issues in terms of fines and court cases which have kind of brought this to the fore as well?
Well, there's been a very visible set of fines with very large institutions. We had to pay massive fines over the last 12 months, a year and a half, and so I think the FSA has been cracking down on the financial firms in the UK, but I think the other regulators are also getting people to pay attention to it. The FSA also has mandated that the firms should hire consulting / auditing firms to make sure that they are in compliance. Which is another not hidden cost. That's a very serious cost of compliance.
So this can be a kind of very serious internal issue for the banks.
It is. Well, it's an internal issue for the bank, but also it's a question of reputational risk and actual protection of the client's interest.
So obviously at the moment there's so many kind of regulatory and technology demands on bank budgets, but this might run the risk of kind of slipping under the radar. And what's the cost of not taking it seriously?
Well, the fines are there for people to be taken seriously. The FSA also has mandated, as part of the CMAR effort, that somebody should be responsible within the financial institution for implementing a proper solution, and so that needs to be published on the financial institution website. So they're really pushing very hard. So the fines is one aspect, the auditing cost is another aspect. But I think more importantly is really not. For the clients to have trust that the bank is really taking the management of their funds seriously.
And how does that play into the kind of broader operational risk landscape?
Well, the crisis has highlighted the fact that the back office is really the last mile of weak or non-automation in Wall Street. We see in very large firms tens of thousands of people in the back office, and if we had been in an STP world, most of these people would be handling investigation versus doing exceptional management by hand. So we believe that to get proper operational risk control, the banks need to retool, move away from batch and legacy systems, have proper real-time cash management tools in place, proper management of the transactions, and proper management of the data in the first place, to get to proper control of the operational risk, which today is still lacking in the marketplace. But I think the crisis has highlighted the need, and the banks are really investing more in the back office and the front office in the last few years to compensate for the underinvestment over the last 10-15 years.
So we've had fines, and hopefully that should mean some of the financial institutions actually get their act in order. But do you see the regulations actually evolving from here on in as time goes on? Well,
the regulators are again very serious about the topic, and they are acting locally and internationally. So the regulators starting working together. We see the US regulators, the regulators Singapore and Japan acting very closely to get the banks really in order to have, again, real-time cash management. So it's really not acceptable that if you go to the bank, say, what is your cash position? And the answer is, well, we'll tell you tomorrow morning at 10 a.m. That is not something that's a viable model. So the regulators are really pushing very hard on the banks across all geographies and all major markets.
So we've talked about some of the things, but what, in an ideal world, should financial institutions be doing, and what, from an operational standpoint, will that actually look like?
Well, I believe that I mean, we see our clients are structuring the trades or size of the trades according to how good the back office or efficient the back office of the counterparty is. And that's the essence of the problem. You're only as good as your counterparty's back office. So you have 50,000 players out there, and the weakest link is going to break the trade. So what we're suggesting is that a lot of the back office services should move to a shared service model or a managed service model, or call it cloud computing or SaaS offering, where the non-core, non-specific services like management reference data, management of corporate actions, management of trade reconciliation and trade break process should be moved outside the back office and be in the middle of the trades, in the middle of the prime broker and the hedge funds, the custodian and their clients, and the brokers and their clients. And if you do that, then you can create efficiency across the whole cycle, which you couldn't achieve internally.
And how much appetite amongst the banks to actually make that happen do you think there is?
There's huge appetite. I mean, we have seen it with our own on-demand service, which is where we have more than 900 clients using that service today. We have seen that. I mean, throughout continental Europe, there's been for many years back office services. You have obviously same thing in the US and Canada, but we're seeing a new generation of services being created to create efficiency across the sales cycle. So the appetite is there. We have a lot of clients using it. It's really, we don't believe in the big bang approach. It's not going to be, oh, we're going to move the entire back office of a very large bank to an external resource. But it's going to be, there's end services in the middle of back office, and they're going to move one at a time, or there's going to be a set of services moving out between, again, the IDBs and the banks and their clients, and that's happening now.
So it's definitely a gradual movement in that direction.
It is gradual, and it's happening, I mean, very very quickly. So we thought before the crisis there was a need to do that. I think the crisis is reinforcing the fact that non-core functions like reference data management, coming up with a proper closing price for IBM's stock price, is nothing unique, right? What you want is to have the same stock price as everybody else. So why does every firm have to do that many times over and across 10 or even more instruments? So it really, I think it's really requesting a very, very strong move to a managed service model where, again, not talking about golden copy, but having proper data management as a shared service makes all sense in the world.
Well, I think that should give the banks plenty to think about, and I think that's about all we have time for. So Philippe, thank you very much for joining me.
Thank you very much.